All right. Hey, Bacon. Good to see you, buddy. Can you just let me know if you can hear me all right? Someone please let me know if you can hear me. For the love of God, let me know if you can hear me. You should be able to hear me. Okay, cool. So, just real quick, let's do a quick test of music first to make sure that that's coming through. So, I'm going to play some music and then hopefully you guys can hear that. All right, so let me know. If you guys can hear this music, then we're off to a good start so far. Okay, cool. We can hear the music. All right, that's good. So let me pause that. Now what I'm going to do is I'm going to play something from my browser. I'm getting my audio set up. Thank you for working with me real quick. I haven't done this and my settings got screwed up in my digital audio panel, so I'm just making sure that we're good to go. Let me play something in YouTube real quick. All right, let me know if you guys can hear this dude talking. It should be okay. Okay, so that's not coming through. Okay, hold on.
Identify the risk.
Yeah, I'm trying to get my sound set up. Just give me 1 second. I'm trying to make sure that I can get my browser audio through. It says it's coming through. Browser is aux, so this should be coming through number 2. Okay, so let me know if you guys can hear this now. You should be able to hear a guy talking. Still silence? Fuck. Yeah, you guys can hear me, but you can't hear the Okay, so hold on 1 second. Let me get this. Let me just get this figured out. Why is it not going through the right? Device properties, app. Here we go.
The work that we perform affects everybody on the street. Every time that you receive a check, we are behind.
Okay, so you guys should be able to hear it now, correct?
Sure that those are secure, that you receive the money that you are supposed to receive. This is very important to secure your transactions, your money, and the economy of this country. In doing this, we are facing many different threats.
Cool. There we go. All right, got it. Thank you so much for helping me out with that real quickly. Let me go ahead and take
really
this
smart people.
thing off the stream real quick. How are we doing? Thank you guys. Thanks for bearing with me real quick while I did that. I wanted to make sure that the audio from my browser was coming through directly. That way everybody can hear everything, so that's good. Now we got that all figured out. Got like 5 or 6 people or 10 people or whatever in here, so that's awesome. Hope everybody's having a good day today.
I was glad that I was taken. Doing my work, sometimes I
get this
think about my
so I think what I'll do
family,
is have this as a pop out.
Whatever conditions we are creating in this economy.
Yeah, I'll just be able to pop it out. Okay, so we have the video live here, but on the, oh, here it is. Here's the stream. So I have to make sure that I pause this audio and have the audio muted before the stream starts, because last time what ended up happening is I actually ended up getting the video completely demonetized. I got demonetized because the music that they had in the background was like copyright. So like YouTube flagged it for copyright. I don't know. It was something stupid. So yeah, so we got this up. I want to start the stream a little early. It's 12:40 here for me, so it should be 1:40 for you guys. I know that these normally start at 2. Sometimes they get delayed until 2:30, so we'll kind of see how it goes today. But just really excited for this. I'm in the camp that what will probably end up happening is we'll probably end up seeing a 25 basis point hike. I feel like that's probably pretty standard. I think they're just going to do one more. Obviously, if there's like any kind of surprise where they don't do a hike today, like all the markets, like market wide, are just going to absolutely rock it. So we'll see. Well, what ends up happening. Just give me 1 second, guys. We'll just take a look at the chart here for 1 second. I'm going to leave this up. My daughter is like yelling for me, so just give me 1 second. All right, and we're back. My daughter had a doll stuck in her doll, like she got her like doll head like stuck in the dollhouse window somehow. I don't know. It was actually kind of funny. Take a look here on the 1 hour, see what's happening. Looks like we're testing resistance right here now. So we'll see what happens. But anyway, I have had like a super crazy busy week. My mind like didn't even work with the with like setting this up today. I was like, my mind was having like a brain fart. It's kind of crazy. So yeah, I'm definitely going to have this audio here muted until, just like I said, like they demonetized me last time because all the music that they use is copyright or whatever. YouTube was being YouTube. So yeah, so see, they moved it and they said, okay, 2:30. So I guess we're just going to be kind of hanging out for, I guess, the next like 30, 45 minutes or so, which is cool. Kind of sucks. I actually might make a sandwich. Sandwich making on stream with Cobra? What is happening? Yeah, so this area is still resistance. Look how long this area has been relevant here. Like I originally drew this on like a 15-minute chart, and like it ended up being like a massive like intraday resistance level. So right now, for the time being, this is red still. This was also relevant still as support. So kind of interesting how these levels have like continued to be relevant like all the way through this price action, all the way back to here, before this like basically high time frame like head fake or whatever. This pretty much turned into a head and shoulders. Those of you that shorted this a couple weeks back, congrats. That was pretty awesome. Nice head and shoulders fake out here. That was awesome. Good reversal there. This, however, has been an absolute cluster. Really, really weird. That's kind of cool though that we came back and we swept these lows here. So that's good to see that we swept these lows. So now we're like retesting. This is like a triple tap up here of this resistance. So this is going to be interesting. If you guys want me to like chart tokens or whatever, feel free to throw those in the chat. We're just going to be hanging out for a little bit before the FOMC starts. Obviously, on like these lower time frames, we're starting to see some volatility over here. It's up here. I'm moving around windows on the other side of my screen. Just give me a second. I was like massively unprepared for this stream today, by the way. Like I was just like not prepared for this. Just a really, really busy, crazy week. What with the algo release and all of that good stuff. So been kind of hectic. And updating my website and relaunching my blog and editing other videos for clients because I do freelance work, and my wife's starting a new job, and it's just been nuts. It's been absolutely nuts. So Ben wants to see AVAX. Yeah, sure, we can do AVAX. Should have it on here. Yeah, AVAX perp. Zoom out to a daily first. Wow, really nice tap into major support here. Looking nice. So we swept these lows. So this would be like if you're trying to buy AVAX for like the long term, this is definitely a spot where you want to start dollar cost averaging. This looks really nice. INJ. Yeah, I'll take a look at that for you. Yeah, this is like a massive area to be accumulating. Like this looks really good. Like a lot of people don't zoom out to like these big weekly and daily timeframes here. So this was obviously like a double bottom, classic double bottom reversal, right? You got that big W shape, and then it broke through this resistance, and then it just went parabolic from there. So the fact that we reswept these lows again down here, that's looking really, really tasty to me. It's pretty awesome. You might be able to get a little lower, but I mean, I would say pretty much, man, anything under $15 is like, that would be, if I'm trying to buy this like long term and accumulate, that's probably where I'm going to be trying to do that. So had a little diamond consolidation bottom here, head fake resistance, slow bleed, little kind of like a dead cat bounce, and then we got this like massive move down. Let's 1, 2, 3, 4. Yeah, this might be the last leg down here. Like if you're in an Elliott wave, that's a 1, 2, that's a 3, that's a ghetto 3. And then this would be like your 5. 1, 2, 3, 4. It technically doesn't break the rules because it didn't break if you zoom in on this here, we technically did not break this high here. So that's technically a valid 4 as a 2 because it doesn't go into like beyond wave 2 territory. So that could be a valid wave 4. So I mean, if this is our last leg down, yeah, like this is where you want to be buying. I think that this wick probably ends up filling though. You might get a little lower, like back into like the $12 region. But honestly, like long term, like if you're just trying to like buy in dollar cost average and just hold this until, you know, like these highs are broken. I mean, like you can't really argue with getting in it, you know, like 15 or even $20. And then this ends up running all the way up to like $200. I mean, you know, that's pretty crazy. So I would say that, yeah, this is probably a really good area to be accumulating this, especially if you're just trying to be holding spot on this. It's definitely worth, you know, throwing like, you know, $250 or $500 at for spot. Yeah, like here, if I was going to be like, if my budget for getting AVAX spot out of my portfolio was like $500, like this is where I'd be buying. Like I'd throw half of that amount in here, and then wait. And if it doesn't go lower, just throw the other 250 at it. Like the only way that you would be in trouble with that trade is if these lows get broken. So like you would be really watching what are the closes over here on this side. So you don't want to see a daily close below, where was this close? $9.62. So basically you don't want to see a close below $10 on the daily chart. Like if you see a close below 10, that means that you're in trouble. But again, if you're dollar cost averaging, if you buy some here at 12 or $13 and it does break 10 and you get a shot at buying this support here, like as a retest of this wick down at like $7, that would be like, I mean, your dollar cost average 13.7. Your dollar cost average would be like 9.75 or 9.25. That's like really good. Like having an under $10 average on AVAX, that's insane to me, especially considering that the all-time highs were like 150. So that's pretty insane. I mean, you know, let's say you got in here and you wait, right? Like you market buy right now and forget about it. Next big bull run, if this ends up going back to all-time highs or beyond, you're talking 1,000%. I mean, that's nuts. So good spot on that, Ben. I like it. Let's see. INJ. I don't even think I have that on here, but I will add it if I don't. ENJ. No, I don't have INJ on here. INJ. Go ahead and add that. Take a look at this. I don't think I've ever charted this before. Holy shit. Okay, so see, this would be a coin. See, this is a coin that's been rallying. Oh, this looks really good here. Got a major, well, let me just draw a box here. You guys kind of know how I chart for the most part. So you've got a really nice support level here. You did have a smaller time frame resistance level here that was retested as support. So this was resistance. Now it's flipped and it had a really nice retest on here. So like this would have been like your max bid opportunity here. And that's probably why this rallied. Everybody saw this resweeping the support level, so they bought. Now it's looking like you have a level. Looks like you're at it right now where there's a level of resistance up in here. Yeah. Midterm support. I'm just going to draw one flat line here and say that this is probably the line. Like if you're buying up here, this is like your line in the sand. Like you can be accumulating at like this 525 level, but I'm going to say that if that breaks, you're probably going to want to close out immediately and then wait for lower, because you'd probably be retesting, you know, this like 250 level again. That would be like a massive drawdown. You know, like if you bought here and then it came all the way down there and you held it, I mean, you're talking like a 60% loss. So that would not be good. Yeah. And then you've got, you know, your all-time high up here as a level. And then you've got like a small resistance zone. It's like right here. Another little resistance zone up there. So you want to take that. I would say we would probably want to take this level by level. Like this is like your overall, like, this would be like your overall super macro support. And then here you've got, what is it? This is this year. So this would be your yearly support. Okay. This right now is like a historical level, but we just blew right through this. So I would probably just rather call this like a monthly, support, because when we broke through this, we were back at the very beginning of last month. So yeah, so that's like, this is like a monthly support level now. This would be your upper range macro resistance here. And this is like your all-time high resistance. And then this is just simply your all-time high. So that's kind of the way that I go through and I level and I like label my levels and stuff. Obviously, everybody does this differently. This is just the way I do mine. Feel free to troll me. Feel free to throw shade or whatever, you crypto people do. But this is just how I've always charted like this. It doesn't matter if it's crypto, futures, Forex. It doesn't really matter. I draw ranges as my supports and resistances. I never pick exact to the cent or to the sat levels because I think it's kind of retarded to do it that way. You want to have an area that is resistance or an area of support where it's like, okay, if this area breaks and we have like 2 or 3 consecutive closes below this area, that's where I'm going to cut, or this is where I'm going to add, or whatever your strategy is. So everybody trades different. This was like a super nice V-shaped recovery here on this last dip. This was really nice. This was awesome. So if we're looking for continuation here, we can kind of estimate, well, from this move up, right? Let's look at this. Okay, so between 382 and 0.5 is where this historical line is here for your monthly support. That'd be a really nice area to be bidding. And then in between your 0.5 and your 618 is the top of this consolidation here. So we can actually measure this out and predict a little bit and have a better idea of, okay, where actually, no, this is an expanding diagonal. So your end of the first wave would actually be this wick here. So it retraced 382. That's pretty normal for a wave 2. So if you measure, if this is a, like you've got, still not live yet. I was just checking this real quick. Not live. We got time. This was an expanding diagonal here as a correction for a 2. So this wave here was your 1. This ABC was your 2. This, I'm assuming, would be a wave 3. Now we can check that by using our fib extension tool, and you just measure the first wave, right? You project it off of the bottom of the second wave, and sure enough, it is more than 100% of your first wave. So this is a valid wave 3 top here, okay? So that's how you can check to see where you are in the overall uptrend, okay? It's just kind of fundamentals of Elliott wave theory. I don't trade off of Elliott wave theory, but it is good to know what the relationships are between how long the waves are supposed to be, because it's all based on fibs. It's good to know what those relationships are. And there's a link below in the description if you guys want a free copy, digital copy. I have the hard copy, but if you guys want, there's a link below. You can get this book for free. And it's the Elliott Wave Principle by Frost and Proctor. Let me get that in the camera. Those are the guys that literally invented Elliott Wave back in the day. So use the link below. You can read up all about it. And the most important part of that entire book is where it explains the relationships of what the rules are for the fib retracements of each wave in impulses and corrections. That's like the most important part of the book. I want to say, as long as you know that, you're probably going to be pretty set. So this is a valid wave 3. So where are we looking for a retrace? Well, the retrace might already be over. This was 382. So we would either be looking for something less shallow or deeper than that, but you wouldn't want to see closes below this like, 70% level. 70% would be here. Okay. So you don't want to see anything below the 70% level. So if these lows here break, and I'll give you this number of where this is on the chart, you don't want to see this low break. So that's like your line in the sand is like 380. You see a close below 380, it's probably not going to be good. And then that means that this trend broke and you're still in some kind of weird elongated consolidation or correction or something. But for now, how you would be able to predict where the uptrend ends is you would take your line in the sand mark and measure down to there. And you'd be saying, okay, well, this is going to end either here at the all-time high resistance, or if it's more shallow than that and we bounce off major monthly support, you'd be looking, basically all-time high resistance up here. Like that's going to be your major resistance. And then from there, that's when you would be able to say, okay, this is a larger, that whole wave one of the correction would be like this. And then you'd be looking for a massive wave two down to like here to retest. And then full-blown bull market would be like, okay, you're breaking all-time highs. You're going to like 40, 50 bucks. And that would just be like wave three. So that's kind of how you can get a feel for like estimating like where in the trend you kind of are. Just like how I just went over AVAX and I said, oh, look, this has been climbing on the way down, right? You've got your 1, you've got your 2, your 3, your 4. This is potentially your 5 or the end of a fifth wave. So, that would be a pretty solid correction here in a 5-wave sequence. So honestly, though, AVAX, in my opinion, while everything else has been like, for the most part, like rallying or turning around, some of these coins have not. So it just really depends how you want to play these. Like, if you look at Polkadot, right? Like Polkadot has just been battling this level. Like I've had this level drawn for like over a year now, and it's just battling this level. Like it just has not been able to break this, and it's in a very tight consolidation range. That would be the point where when you look left over here, it's like, oh, damn, like $5 is like major technical and psychological support. That's probably where you want to be looking. 700K Apple long into FOMC. Let's go. Wait, is this actually Nebraska and Gooner in my stream? Or is this a troll and it's not really? It might be a troll. I don't know if it's actually him or not. That'd be cool though. What's up, man? If it's really you. Brenoskin Booner. I love it. I love to see it. Yeah, that's a sick trade. If you just let me actually go to the my legacy stuff right here. Oh, by the way, all of these watch lists and stuff, like all of these are public. Like I've shared these. I don't know where it says that. Yeah, share list. So like if you guys want like my ticker list for all of my legacy stuff, you guys can use that. I'll put that in the chat for you. Exited 170.52. Fuck yeah, dude. Hell yeah. I haven't even gone back and recharted this for a long time. This is still resistance. We broke through this one. This is now support. So this is like max bid area right down here is like in the high 150s, like 160 is like the max bid zone. FOMC runs, yeah, probably. It's probably like the dump or the pump before the dump, man. Like honestly, a lot of these things, what ends up happening is like we pump for like the week or two into FOMC, or at least that's how it has been. And then like the day of FOMC or like the day after, like the prices start like reversing and cooling off a little bit. Buy the rumor, sell the news. I mean, there hasn't been more perfect examples of this than literally the last year and a half of FOMC meetings. It's been like clockwork. The week before FOMC, we start pumping. And then the day of, it starts selling off. There's a ton of volatility, and then the price cools off for a week or two after. So it's pretty legit. FOMC increased 25 basis points. Yeah, I agree. I think that that's probably what's going to end up going down today. I don't see a reason why that wouldn't be the case. But if he says today, like if Jay Powell blesses us and just says, okay, we're gonna pause today, like they don't do a hike today and they pause, that's going to be like Jerome Powell is literally going to pump the shit, like just going to pump the shit out of these markets, like completely laser eyes. He's just going to manifest the shit out of it. That's going to be pretty cool. But yeah, I don't see a reason why there wouldn't be a 25 basis point hike. But again, I brought up the S&P 500 chart here, which I've been following very, very closely. And this is like very, very reminiscent to me of the consolidation that we had in like 2007 or 8 before we had the last like massive leg down. But obviously 2008 was kind of like a black swan thing, like tons and tons of banks failed all at the same time. But if you actually look at the statistics and you start adding up the numbers, what's interesting is that just the few bank failures that we've already had, so like First Republic Bank, Silvergate, SVB or whatever, like those big three that have failed, just those big three in dollar amount of going under totals already the entire banking crisis that we had in 2008. So I thought that was very interesting because it's not something that very many people talk about. It's like, oh, wow, those three banks in value were worth all of the banks that failed in 2008. Whoa. It's like, you know, when you look at that stat, it's like, damn, like, what are the implications of that then if other banks fail? Well, and the chart that I looked at, it was adjusted for inflation, which I think is very important. A lot of people put those charts out and they're kind of like a troll chart. Like they don't really tell you if it's adjusted for inflation or not. The one that I saw was, and I thought that it was very interesting. I'll see later if I can dig it up on Twitter. Somebody posted it. And I didn't retweet it. I should have bookmarked it or something, and I didn't. I kind of fucked up. But yeah, so I don't need this window up anymore. So this is going to start 2:30. So we got about 25 minutes. It's 1 p.m. obviously for me. I'm Central Time, but we got a little time for this. I do have the audio muted, so it is correct that you're not hearing this. Again, last time I got demonetized because they used copyright music, so I couldn't even post the recording of my live stream because like an hour of streaming before the FOMC started, they were like, copyright, and they didn't let me like, I just I forewent the whole video because of that. But anyway, back to this chart, like this is a massive level of support here. Like we bounced off this really hard off this first, nuke that we had. And we had one throw over of this level, but minus that throw over, like this has been a very clearly defined range, like overall, very reminiscent, of the consolidation that we had before. Small pump. Yeah, I 100% agree. If we get like, if there's no hike, it's going to be intense. Like this is just going to, we will break through this resistance. And this would be the last level that I'd be looking at on the S&P to be breaking is like 4,300. Like that would be like the last one. I want this press conference, man. I want the press conference. Let's go. That's where like all of the juicy information is. So. Oh yeah. And I forgot to mention that yesterday I updated, 1,300. Yeah. Well, I mean, I'm on their YouTube. What's going on? Press conference hasn't started yet. It says 2:30, so like 20 minutes. So, yeah, normally he does like his little talk, his blah blah or whatever, and then he takes questions and stuff. That's like the juicy part because that's when he may or may not sometimes let things slip of like how truly hawkish or bearish he is. So I can't even imagine. Yeah, so I think they released the information early. I normally don't pay attention to that and just watch, the actual thing or whatever, because that's where he does like his announcement. his actual like written statement, and then he takes the press conference and stuff. But yeah, I mean, if it's already released and it's 100% confirmed that it's a 25 hike, then whatever. That's 100% what pretty much everybody expected today. I'm not really too worried about that, but so classic FOMC volatility right here, right? For the day, big pump, big dump. Now we're kind of reverting to the mean here. This is just today's price action, or this is just, you know, like the last couple days here. Pump and dump, buy the news, you know, buy the rumor, sell the news. So that's interesting. Let's come back to Bitcoin real fast. Look at that wick up. That's so crazy. I think that when the press conference occurs, because most people are going to be watching this press conference, and that's, I think, when we're going to see like the second half of the volatility for the day. Yeah, at 100%. That's where the volatility is. Make pterodactyl noises. Thanks for checking out the stream, man. Appreciate it. Always glad to have you. I haven't even eaten lunch yet, and it's like 1 o'clock. That is insane. I'm gonna be super hungry. I've got like leftover Kung Pao chicken. That is gonna be happening today. 100%. If you ever say that you're going to go on the roof and yell like a pterodactyl, or if you're like, I need to go do lawn care, like I need to go do lawn care, I need to take care of my lawn. We need more Gooner threads on lawn care. That's what we need. I think that Gooner should start a completely separate Twitter account strictly just for threads on lawn care. Gooner Green Thumb. Get some Gooner Green Thumb Twitter action going on. Be legit. Let me actually bring this over here too. Get this off my screen. Bring this over into here. Da-da-da-da. Ho, Shipperson is in here. He's driving around in his truck, listening to the stream. Let's go. I really hope that we get like more volatility on this smaller time frame here. My algo just went live and it really thrives off like really crazy like spikes and stuff. I'll actually go back here. Let me bring it up and I'll show you guys. Now, mind you, this is a 5-minute time. I have to take some things off the screen first so I don't dox my algo, but I'll bring it up here for those of you that don't know. But anyway, this is pretty much what ended up happening. So on this move to the downside, it exited a previous short here and then just like chilled out and stayed flat until it longed the bottom. It shorted this tiny pop, took profit on it, long, took partial profit here, and then closed and then re-shorted like this Pico top, took partial profit, long the bottom, exited the short, obviously, took profit here, and then it just like stayed in the long throughout all this nonsense price action. And then it closed in profit. Since it longed down here, it closed in profit. These lines are the final take profits and the trailing stop losses for the positions. But ever since then, it's just been like, we haven't really seen very much movement in here on this 5-minute time frame. And it's really just, kind of just crawling sideways. So I was really hoping we were going to get some like really nice blast of volatility. So it was going to like either fade or get in on the move. But so far we haven't really seen that. My oscillators aren't totally lining up here. So, and that's mostly just because it's chopping. So I'm kind of expecting this to move at some point during the presser. which would be nice. So I'm going to be expecting that to be happening shortly. Oh my God, go. This window will not go in. There we go. Wouldn't go onto the side of my screen. The hell? What the hell? Need to catch up soon. Maybe once May is over. Yeah, dude, it has been like really crazy. This whole month has just been like insane for me. I don't want these stupid like one candle engulfing wicks here. Like I want some real solid price action like on the 1 hour chart. You know what I mean? Like give me like a $500 candle, you know? Not these little like, oh, I'm going to move $100 and then retrace. I don't want that. I want like a $500 move. Let's go. These are like little $100, $200 moves. Like, what is this? A pump for ants? Let's go. Let's get this done. And yeah, no, we totally need to catch up, man. I don't know. We'll do something. I mean, it's Cinco de Mayo on Friday, but I don't know if we're going to be doing anything. Probably not. We're probably just going to like do tacos and margaritas at the house. So we're probably not doing anything for that. Gotta hold on 1 second. What? Oh man, hold on. I think I'm in trouble with my daughter. 1 second. My daughter locked herself out of her tablet. Anyway, yeah, no, we definitely got to hang out soon. I need more of those ice cubes too, man. Or I just need to actually, you know what? I might just. Can you tell me what was the website for it? I thought I had it. I don't know what it's. What the hell is it called? Cool ass clock. Arrow Garden. The hell was the freaking ice thing called, man? I thought that I had it. I don't know. I thought I had the web address saved. I guess I don't. I forgot what his he brought over this really awesome cubed clear ice, and I've tried a million different clear ice solutions. Those of you that are whiskey drinkers, like, you know the advantages of clear ice. There's no impurities in it. It doesn't mess with the flavor. They melt a lot slower. And he brought over a bag of these clear ice cubes, and they were awesome. Took me a while to go through them because I wanted to like save them. Clearly Frozen, that's what it's called. So Clearly Frozen, if you guys are in the chat, you guys need to sponsor me. We'll just search Clearly Frozen here. Clearlyfrozen.com ice maker. Oh man, it's not even $40. I'm down. Yeah, and the cues are, man, they've definitely redone. It looks like they've redone their website since I bought it. Yeah, see, so like that's clear ice. That's like the garbage ice that comes out of your fridge or whatever. Like, look at the difference. Like, that's all like air bubbles and impurities and nonsense. And then this is like actual clear ice because it freezes. It uses you make clear ice by directional freezing. Really, really cool. So I definitely want to get one of these. I love how they show it in a glass of water, but everyone knows that it's really for whiskey. Bar restaurant supply, how it works, gallery praise, weird ice science for. So what, I would just order it. So yeah, I guess this is the one that he uses. This thing looks like it's pretty big. Complete unit measures 12 by 6. It's not that big. Plus it makes like a lot. It makes 10 at a time. So that's worth it. We ship by UPS. Damn, it's an extra $18 for shipping. Damn, that's pretty expensive. I could probably get it on Amazon for cheaper and not pay the shipping, right? I mean, like, I can't imagine that this private company is not selling on Amazon. They wouldn't make any money if they weren't. Yeah, so they sell them on Amazon. Clearly frozen. Yeah, so it looks like this is definitely the one. I don't know. Are these scam? I mean, this one has the logo printed on it supposedly, but I don't know. Are these like imposters? They have the same pictures as the website, but you can easily just copy and paste those. So I don't know. It says it's by brand Clearly Frozen. So does Clearly Frozen have a page on this for? I don't know. I think I would just have to like trust that it's an actual Clearly Frozen branded one. But it looks like it. I mean, the pictures of the reviews say that it's from Clearly Frozen, so that's good. It doesn't look like it's an imposter. I mean, for something that makes 10 ice cubes at a time, mine looked more like this. Mine, the ones that Shipperson made didn't actually have all these air bubbles in them. But even with that, it's like very negligible. Like it's not. Oh, damn it. And you get extra clear ice at the bottom too. That's awesome. Yeah, so I think this is the actual one. That's what the cubes actually look like. Yeah, I think I'm going to buy one of these. I'm not going to get it right now and like dox my credit card, but I'm probably going to buy that later. I'm going to write down in my nice leather book here that it's Clearly Frozen. Best decision I ever made for taking notes and like writing down schedules, ideas, thoughts, journaling, my trades, whatever, was getting my hands on like a real legit like leather and string bound, like notebook. And then getting like an actual pen, like a real one, like a real fountain pen. It's just so much more satisfying to write with. And the paper in here is pretty good. I got this off Amazon too. If you guys are interested, let me know in the comments. And I'll post you guys a link to the book that I use. But like it's actual, like it's real leather. Like it's not like fake faux leather. You know what I mean? Clearly Frozen. And I can get that off Amazon. Yeah, I'm going to get it off Amazon instead because getting it from, I want to buy it. I always like buying stuff directly from like the manufacturer's websites and stuff, but I'm not paying an extra like $18 for shipping. Like that's pretty ridiculous. I'm not paying $18 for shipping. I can get it shipped on Prime for free, so I'm not wasting my time with that. But looks like our presser in his written statement or whatever is going to start in about 8 minutes. And this is where I'm expecting the volatility to be, like right here. This is what I'm expecting. So I would love to see a breakout of this and then like a retest of these highs. Like to be totally honest with you, I would probably be reshorting here. Like if we made it all the way up here on FOMC volatility, that is where I'd be fading. Like I would be trying to fade that move. I'm not long currently. If I was, I probably would have bought like here in this consolidation or here on this retest of this small consolidation here on the 1 hour chart and bought, in this area here on this retest. But I didn't get into that. So obviously I don't want a long underneath resistance. So instead I would just be waiting, like manually trading I'm talking about here. I would just be waiting for like a move up to fade that move here. Felt like an equal high. We actually have a higher high here on this wick, but we're getting like divergence on this RSI here. So that's why I would probably be fading that move, because even if we broke through this high in price, we wouldn't be breaking through this high on the RSI. It would have to move like 10 points in like one candle. Like that's not going to happen. So that's probably why I'd be fading that. But I don't know. We'll see. we'll drop it down to like a 15-minute, and we'll just kind of like observe this price action while the presser starts. I wonder if what I can do is just like pop this window out. Get rid of this. Get rid of this. And then go ahead and open up. Make sure this is muted. Okay. Organize my windows on my screen. You know how we do. Yeah, we'll just kind of observe this like that. I'm gonna bring up one other chart. This is going to be SPX. And we will bring these down to a 15-minute time frame. Actually, let's do a 5-minute time frame. We'll bring them down. Zoom out just a hair. And wait for the volatility. Actually, you know what? I'm actually going to switch this to like this. That'll be a little easier to see. There we go. That's a lot better. Now we can really see price action. Does that work for you guys? Hopefully that works for you guys. Oh, I'm almost out of water. Anyway, guys, thanks for tuning into this stream. We're going to see this press conference here in about 3 or 4 minutes. If you're new here, make sure that you smash that like and subscribe button down below. There's a whole bunch of helpful links in the descriptions. Make sure that you follow. I really would appreciate if you guys follow my @VenomAlgo Twitter handle as well for all the updates on the algo and stuff that just went live. You can actually sign up for that with a limited time 15% off coupon with the code ANTIVENOM. So if you guys are interested in automated trading or diversifying your portfolio and having part of it automatically traded for you with my own proprietary algorithms, make sure that you check that out. They're all hosted on the Astrobit platform. Come on. What's crazy is I used to live not in DC, but like 20, 30 miles from DC. I used to drive past this every day because I was obviously not on the DC side of the river. I was on this side of the river. And I've stayed at the Sheraton before. I know exactly where this is. I don't know where the camera is, but I know where this monument is and this monument here and the Sheraton Hotel. Pretty cool. So glad I left though. It was like just DC and the 50 miles radius surrounding it was just turning into an absolute it was just garbage. It was just dumpster fire. The traffic is crazy. I literally worked like 15 minutes away from my house. It would take me over an hour in the traffic to get to work. It was just insane. Super happy I moved out here to the Midwest. Everyone's nicer out here. Everyone's really chill. There's no traffic. Prices are cheaper. School for my daughter is cheaper. Daycare is cheaper. Food is cheaper. Just everything is less expensive out here in the Midwest. And all the people are a lot nicer. So I'm very, very happy with the decision that we made to leave. So hopefully they're actually on time and this actually starts at correct time here. All right, we're getting a little volatility, not anything crazy though. I don't know, like maybe is there just not as much volatility today because pretty much everybody knew ahead of time that it was going to definitely be 25 basis points. Like I feel like there's, I don't know, like for literally the entire like last year, everyone was like, oh, it's not going to be 75, it's going to be 50. And there was always like a lot of questioning about what they were actually going to do. Is like everybody, no matter if you're bullish or bearish, like everybody agreed that it was going to be 25 basis points before they actually made the announcement today. It's kind of weird. Like that hasn't happened in a while. So I'm assuming maybe that's why the price isn't moving so much. I don't know. It's just kind of funky to me. There's a lot of selling coming in up here at this resistance on Bitcoin. I mean, like, but in general, it's like, we're just staying in this little, $200 range here. Not really moving. We had a little pop and it just gave back 50% of what those gains were. And we're just rejecting from this tiny resistance. All right, here we go. Come on, Powell. Stop dawdling. Get up there. Let's go. Come on, little J Powell. Come on, little fella. Is this boomer gonna seriously sit here and record this with his phone?
Good afternoon. Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate.
It's the same thing he's been saying for a year.
Monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%.
Jesus
Excluding the
Christ.
volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
Oh, there it goes.
We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to
And
our
there's the
2%
sell-off.
objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses.
Good.
In turn,
That's what
these
we
tighter
need to have
credit
happen.
conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
Well, here we go.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so,
No,
what
they
the
haven't,
recession
and you're an
like,
idiot.
what
They
their
literally
vision
just
would
said
look
they're
and feel
going
like, what
data-driven
that's
month to
different than the
month.
unemployment rate.
So he's not going to tell you that.
So Taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation at 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is, so let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
So the minutes this time around, when that's released, like next month or whatever, is going to be a pretty big deal.
Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see...
He's not going to tell you that. He's said a million times he doesn't get involved in politics. All these liberal journalists just like, it's like they're retarded.
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really
it's not our business. We don't give a shit. He's said it a million times, and they keep asking him.
It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse.
I just hate how they always try to make him like take a political stance.
We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time.
Yeah, of a default. The Fed won't be able to do anything if the U.S. defaults.
That we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say it did. It was, of course, it's something that came up. We talk a lot about risks to the
like literally a slug could answer
people did raise that as a risk
the Washington Post and the New York Times questions.
Monetary policy decision, yeah.
Steve.
Chairman, thank you. Yeah, Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank which talked about the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't, it wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves or many banks are now are attending to liquidity and taking opportunity now, really since the events of early March, to build liquidity. You asked about the separation principle. Like so many things, it's very useful. But ultimately, it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities, and at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was, they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Thank you.
Go to Victoria.
Yeah, he's not going to make a direct comment on one particular bank failure. That's just not a thing.
Bank turmoil. We've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So,
he has no concern about it. That's his fucking goal.
Consolidate banks. There's been consolidation,
and there haven't been multiple banks buying other banks. There's been one bank buying all the banks, and that's J.P. Morgan. Everybody knows this. We're not stupid.
When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things.
But that's not what you want, is it, Powell?
Is it a financial?
You say that that's what you want, but it's a lie.
In terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely.
So see, he's going to try and shift blame to the FDIC, which is a separate organization, about the buyouts of the banks.
Deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
No, he doesn't give a shit about that.
Policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually.
Oh, see, now all of a sudden it's an exception. You see how they do that? They did that shit all with COVID too. Oh, it's an exception.
And that could have been the outcome, but ultimately,
right? Okay.
We have to.
Not buying it. Sorry, guys. Not buying it.
Least cost bid.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
That was literally the very first question, or are you going to pause or do more rate hikes? And he's going to say the same thing.
Quite impossible to have a precise estimate of the words.
Exactly. It's impossible to have an estimate. We're going meeting to meeting with the data.
When we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted.
Oh, see that? He almost slipped up and said we don't know how persistent these bank failures are going to be. That's almost what he said.
To pause rate increases, perhaps.
He almost let that one go.
Even if the data remains strong, then if it's having some kind of substitute effect.
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way: the assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned.
Yeah, exactly what I said he was going to say. The same thing, meeting by meeting, data-driven. He said the same thing over and over for a year. He's said it his entire career. We go meeting by meeting. I don't understand why these journalists just waste his time with this nonsense. Like, they do it meeting by meeting. That's it. Stop asking the same questions every quarter or every 2 months or whatever. Like, it's stupid.
Further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening.
It just makes Jerome Powell, maybe it's a tactic to make it look like Jerome Powell is blowing smoke up everyone's ass or something. I don't know, but it just seems so redundant. They ask the same question every meeting.
So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need.
Yeah, exactly. He was trying to say it in a different way. Are you going to pause? Everyone wants to know if he's going to pause.
That would mean we think we've reached that point.
They're trying to squeeze it out of him so hard, and he's not giving it to him.
Now, but nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
And a follow-up on credit, but could you give us a sense of what the SLUS survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLUS on May 8th, in line with our usual time frame. And I would just say that the SLUS is fairly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Let's go to Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down
What
the
do you
pace
mean, why?
was to see the effects of your moves, and now you've, for the last 2 meetings, been seeing the effects of those moves. Why did the committee feel it was necessary
No,
to
that's
keep moving?
bullshit. This dude is trying to basically say that the bank failures were caused by him, and that's a bunch of crap. That's a lie. And then he's trying to be like, well, you caused the bank failures, so why did you still hike rates? Like, that's dumb. It's not a thing.
A policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And, you know, that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So, you know, we really, you know, we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, you know, you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
Yeah, I mean, as I mentioned, I would just say that this assessment will be an ongoing one. You know, you can't, with economic data, you can't. You've seen, take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that. You know, that
The overall trend is down.
Data will persuade you that you've got this right, kind of thing. And you know, we have the luxury.
Yeah, he's not saying like 6 weeks of data isn't going to do it. It's going to take like, you know,
probably you can calculate
6
in many
months.
different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1 year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what most people would, many people anyway, would assess as you know, the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like, you know, we may not be far off, or possibly even at that level.
Ooh, that's the closest he came to saying we're pausing.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation as the projections show at the end of this year.
Oh, he got a bald head. We good, fam. He got a bald head.
Period of 3% inflation and hoping for some outside event to move down to 2% target.
Look, I think we're always going to have 2% as our target. We're always going to be.
It's 2%'s never going to change.
I'd be okay with a prolonged 3%.
You know what? It's. Let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process.
He's been saying this for literally like a year. 2%, 2%, 2%, 2%.
Stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number.
Yeah, it's still 2 to 1.
Person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment.
Dude, whatever. It's 3.6 unemployment. There's no like softening of the labor market. Like
last week, and it's
everyone has a job, and if you don't have a job, you get another one super fast, and you don't even have to file for unemployment.
Consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments. But the labor market is very, very strong. Whereas inflation is running high, well above.
You notice how no one asked
right
a
now.
single
We're focusing on
question
bringing
about
inflation down.
commercial real
Fortunately,
estate?
We've been able to do that so far.
Not
without
a soul.
unemployment going up.
Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP.
He's not going to tell you that we're going to have a recession.
And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast. Possibly
He's
also
going to go
the
back to his
committee's
the
forecast
jobs
as well,
excuse.
and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say,
he just called the guy an idiot.
That this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think,
how is
the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in expansion. So, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that, if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with.
That would be a massive slowdown in the wage growth over the long run.
By the way,
going from 5 to 3, like just that 2%, it doesn't sound like much, but it's a lot.
You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that. That wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply.
Yeah, honestly, Nick,
in many parts of the economy where supply
I was expecting more volatility too. This is kind of a nothing burger. I'm kind of upset and disappointed.
The way the market clears is through higher prices. So to get, I think as goods pipelines have gotten, back to normal.
Yeah, I'll check the ETH chart in just a little bit.
That kind of thing. I think you will see.
Once this is over, I'll take a look at it real quick before the stream is over.
As a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it will, of course, it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. It's, again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in
shrinking the balance sheet
a little bit more due to what's happened. And we have to factor all
just bailed out Silvergate Bank and put $800 billion back on the balance sheet.
Of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we're thinking.
What about the idea of rate cuts?
Yeah, so
they're not going to cut rates.
We on the committee.
It is nowhere close to that time.
That inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate and to cut rates, and we won't cut rates. If you have a different forecast, and markets.
And there's the hawkishness. We will not cut rates. That's what I was waiting to hear. It's not fucking happening.
We'd factor that in, but that's not our forecast.
They're either going to keep raising slowly, 25 at a time, or they're going to pause, but they're not making cuts at all until they hit 2%.
It really hasn't moved much, and it's quite stable. And so we
housing hasn't moved at all.
Demand will have to weaken a little bit, and labor market conditions may have to soften a bit more.
In other words, people need to be more broke.
And in that world, it wouldn't be.
No one's broke yet
for us to cut rates.
Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table?
See, now that's a great question.
So
props
we
to
looked
her.
at that very carefully,
That's
as you
awesome.
would
I
imagine.
love that
And,
question.
It's
what about the overnight
really
buybacks of the bonds and shit?
Now. It hasn't actually been growing. It moved up, it moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which, by the way, have really stabilized now, what happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including
CDs.
money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had
I would not necessarily call that unusual when you start getting big banks failing. But okay.
That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
That was a good question. Props to her for that.
Sarah Ewell-Weiss, CBS
That's not
News.
something that you
I
get a
wanna
lot.
go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets? And
He's not. He already said he's not going to answer that because it's uncharted territory. Come on. Man, we can't catch a break. We get one good question or two good questions, and then it's right back to the fuckery.
It's just
ridiculous.
A thing, and again, I would just say we don't. No one should assume that the Fed can do. Can really protect the economy.
Anyway, just taking a pause here, guys. Make sure if you're new here or if you like this kind of content, make sure that you like and subscribe and hit that little bell notification. That way, if you're not on Twitter or something and you miss my post, you'll get notified when I'm getting a scheduled FOMC or stream. I stream every Friday as well.
In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the regulatory or the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way: a large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system.
Correct.
I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that may just have been technology evolving. We have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them, and that's kind of the only thing I care about and I feel like I am accountable for doing everything I can to make sure that happens.
Awesome. I love that answer.
Thank you. Evan Reiser with MNI Market News. Chair Powell,
Nice.
Are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
He's not going to answer either of those.
I guess I would say it this way. There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period is an important step toward drawing a line under that period of severe stress, okay? I also think we are very focused on what's happening with credit availability, particularly, with what you saw in the beige book, and you will see in the SLOOS is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity.
Yeah, they're not. Yeah, no one's going to be able to get loans, and that's what's going to start tightening the economy. Purchasing is going to go down. That's when we're going to see the drop.
and we'll factor that assessment into our decisions in an important way going forward.
Okay, Greg.
Thank you, Fed Chairman. Greg Robb from Market Watch. I just wondered if you...
Yeah, see, on that statement, the market started coming down a little bit, too. If we switch back to this chart here.
Leading up to it over the last... Since you've been Fed Chairman, I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And, yeah, comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations, and I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for supervision, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall deploy policy recommendations, develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel my input privately, and that's, I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires.
Yeah, he's not going to take a political stance. Again, they're trying to get him to take a political stance and shit. I don't like how they keep urging him to do that. It's always...
It's more...
it's so off-putting to me that they try to do that to him.
Views and having an intelligent discussion about what's going on and why. And
he's elected by Congress. I don't have any control over it. I work with him as best I can, give my input. That's pretty much all I can do. That's who Congress elected for that role.
Supervision.
I just wondered if you had any regrets, or was there anything that, decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean,
I bet he has.
I think that you could have done things differently, but honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Nice. Well answered. Control the controllable. I like that. That's the tweet.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. There's a sense that we're much closer to the end.
She's kind of a little cutie over there, isn't she?
As I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close, or maybe even there. But that's going to be an ongoing assessment, and we're going to be looking at those.
Yeah, they keep trying to get him to say if he's going to pause or not. He's not going to say it. He's just not going to say it. I guarantee you.
That and the changes to the statement, is the bar higher now to raise rates at the next meeting, or would a strong jobs report or
he's not going to answer that. It doesn't matter how you word it.
I don't want to. I couldn't really say. I just think we're.
See, I can't really say. He does like they keep
quickly,
pushing it.
and I think we can afford to look at the data.
It's not going to happen. He's not going to answer that.
And make a careful assessment.
And we'll go to Nancy for the last question.
Oh, last question.
Hi, Chair Powell. Nancy
And then I'll
Marshall,
answer your
Bank Service
questions.
Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What
I
are
bet
those
she was a
lessons?
cougar back in the day.
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history.
They keep calling it a run on the
That
bank. It wasn't a
now
run on the
needs to be
bank.
reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that, that will play through. It will be up to Vice Chair Barr to really take the lead.
And that's
in
the first thing
designing
I'm going to talk about
ways
after
to
he's
address that.
finished.
But I think that's one thing. I guess I would just say that. Then we're going to revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
No, he's not going to get specific.
That's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
All right, that's it. All right, so the first thing that I want to comment on is, let's get this out of the way. Okay, I'm just going to go back to full screen for now on my, what the hell is happening here? Why can't I drag my chart? Did my charts freeze? What happened? What is happening here? Oh, awesome. My chart was frozen somehow. That's fun. Thanks, TradingView. Appreciate you. Anyway, let me jump back to full screen here. There's a couple things that I want to touch on. The first thing that I want to touch on, and oops. Hold on. Let's get this back properly. There we go. All right. So, first question Nick had was, I should be a professional commentator. Yeah, the stupid responses really get me. I mean, it's the same thing every meeting. I've been watching these for years. It's just the same kind of shit. It's just really funny to make fun of. But I appreciate that. Check the ETH BTC chart. No, I'm not going to forget to do that. I will right after I go into a couple things here. I was expecting more volatility. Yeah, so was I. It was kind of a nothing burger. What are your thoughts on meeting of the minutes being really volatile? So the first thing that I want to get into is that's kind of what's going to determine if they're pausing or hiking again. I think the language and the vocabulary that is contained in the minutes is going to be very important. Now, for all of you guys to reference, if you want to know when that comes out, you can simply go to the Federal Reserve, you go to their calendar, and today was the FOMC, and you look for the minutes. Where's the minutes? It's probably here it is. Okay. At the end of the month. Okay. Minutes right here, 2 p.m. Wednesday, the 24th. So you've got you've got 3 weeks from now. Okay. So 3 weeks from now, the minutes are going to come out. That's probably what's going to be very important in terms of the language and the vocabulary of defining if the Federal Reserve in general, and the decision of all of the people that sit on the board, are going to continue and hike again. Okay, like another 25 basis points or whatever. I don't think, here's my thing. I don't think from now on, there's not going to be an increase in the hike rates, right? Like we started at 25 a year and a half ago. They did 25, they did 25, then they went to 50 and they did 50 and 50 and 50 and 50. Then they went to 75 and they did 75 and 75. Then they scaled it back and they did a couple 50s. Now they scaled it back and they did 25. Now they did another 25. We've already reached the peak of where they wanted to be, that nominal 5 to 5.25%, right? So we hit 5%. Everyone was wondering, okay, you hit the beginning of the nominal percent that you wanted to be at. Is this it? Is this it? Are you going to pause? Are you going to pause? He kept saying over and over, we're not sure. We don't know yet. We need some more data. We'll figure it out. And I think what's going to happen is there's actually a lot of numbers that come out before the end of the month. And I think that largely they're going to make their decision based on that. And like those reports, and they're going to go from there. Could they hike another 25 basis points? Yes, absolutely. And Jerome Powell made it perfectly clear that due to the labor market, and there's still 2 to 1 jobs for every, 2 jobs for every 1 unemployed person. And the employment is still sitting at like 50-year lows at 3.6%. And have they seen wage growth slow down? Yeah, but the inflation is also starting to come back down too. So like that's kind of normal. Are jobs hiring everybody like crazy? No, hiring is slowing down too. So I think what's going to end up happening here is they may or may not hike another 25 basis points. We'll have more clarity on that in the next 3 weeks when the minutes comes out. That's when you will see volatility, because if they are really dovish in that report, that's going to mean like, okay, there's probably a really good chance here that they're going to be pausing and that we're not getting any more rate hikes. He has made it abundantly clear throughout not only this entire year, but all last year as well, that rate cuts are not happening anytime soon. It's just not going to happen. Okay. And so I thought it was really stupid that guy asked that question. Oh, well, do you think you're going to cut rates? Like, oh, please save my bags. Like, no, we're not saving your bags. We're the Fed. We don't give a shit about your investments. No, we're not cutting rates anytime soon unless you want like hyperinflation. Like that's not a thing. He's been very clear on that. He's been very stern for the last year in every single meeting about reaching their 2% nominal inflation target over time. I think he's 100% right. It's not the kind of thing where we're going to turn around before the next FOMC meeting and be like, oh, look, inflation is down to 2%. Like that's not going to happen. It's going to take another year for that or more for something like that to happen. These things move slow. My predictions over the next like 6 months, or at least like until the end of this year, are they may or may not do another 25 basis point hike. I think personally that they don't. Mostly because of Vice Chair Barr, and I'm going to get into him in just a second. Don't you worry. And the Silver Valley Bank or whatever the fuck, SVB. They may or may not do 25. And then from there, they're just going to pause. They're just going to not hike rates. They're not going to cut rates. They're not going to hike rates. They're just going to leave it there. And they're just going to let the pressure sit on the banks. If more banks fail, It's probably because of faulty business practice and risky investments that they made. The Fed has no control over that. That's the oversight, and that's Barr's vice president. That's his fucking problem. That's Congress's problem. That's the SEC's problem. That's the CFTC's problem. That's not the Fed's problem. It's everybody's problem but the Fed. The Fed has nothing to do with oversight and regulation of these individual banks and their practices, what they're deciding to invest in, what the hedge funds decide to do. That's all up to Vice Chair Barr and Congress and the SEC and the CFTC and the Oversight Committee. That's what their job is. That's not Jerome Powell's job. So let's just make that very clear right now. For those of you that don't, maybe you're tuning in from another country, you don't really know how the U.S. economic system works. That's how it works. So anyway, Vice Chair Barr, back to what I think is going to happen over the next 6 months. They may or may not hike, as I said. And what I think is going to happen is they're going to pause for like a while, probably until the end of the year. Because when you think about it in June, July, August, September, October, November, December. Yeah, that's the end of the year. It's halfway through the year. Giving it 6 months, which would really only be, I think, another 3 FOMC meetings, and just let it pause. I think that would really be the right way to go, because at the end of the day, when he said, oh, well, wage growth is starting to slow down. It's not going to go backwards. It's like it's peaked and it's starting to just like curve off. Like on the top of the peak, it's just, doing one of these, and it's going to end slowing down. Job growth also slowing down. Like that's good. Like it's starting to slow down. People are not working 2 and 3 and 4 jobs and just raking in crazy amounts of money anymore. Wage growth, like It's not just, oh yeah, look, I can work at Twitter and do absolutely nothing and go drink a latte for 3 hours and make $80,000 a year. That's not a thing anymore. Like, that's coming to an end. We're already starting to see big tech companies and just large corporations and international companies in general, heavy layoffs. However, the job market is still so strong that those people aren't filing unemployment. They're going right to another job. That's why the unemployment numbers are staying so freaking low. I think that that's also going to be changing soon. When you get wage growth slowing down and you get job openings slowing down, the very next thing that's going to happen is middle America, average sized companies and small businesses are going to start their layoffs. That's when you're going to start seeing those unemployment numbers go up. That's when you're going to start seeing the unemployment claims start going up. That's when you're going to start seeing those guys that are out of work. There's not going to be job openings. And that's where that's the period that we really need to get at. Staying at 3 or 3.5 or 3.6% unemployment for like literally a year is not normal. Like, I know that sounds great. I know that retards sorry, YouTube, please don't censor me. Like Elizabeth Warren. Yeah, like that's, oh my God, what happens if you do that? The unemployment rate might go up by 2%. It's normally at 5%. Like, that's a normal number. And oh my God, 200,000 jobs. Like, there's 380 million people in this country. Like, 2 million jobs or 200,000 jobs is like, it's like a little blip on the map. Like, it doesn't matter. So I think what's going to happen, wage growth is slowing. Job openings are slowing. That means companies are going to start downsizing. And at the same time that this is happening, we heard that he mentioned that the credit sphere is tightening, right? Like, that means smaller banks, that's community banks, local banks, regional banks. They're not really just dishing out credit cards and loans to every, Dick, Jane, and Harry that decides to come into the bank anymore. They're not doing it. Doesn't matter how good your credit score is. They don't want more credit exposure because they know that with wage growth slowing and job openings slowing down, that means that all the people that they already have that took out a lot of credit might not be able to pay it back. That's a credit crunch. Okay. So that's what's coming, is a credit crunch. Okay. That's when you'll see like smaller banks fail, like really just kind of like no-namers. Most of them probably wouldn't even headline. It's just like, oh yeah, look, like this one fucking bank in my neighborhood that I've never banked with before just kind of shut down and closed its doors. It's like, how many people are really getting affected by that? Not very many people. It's all FDIC insured. They all get their money back. It's not that big of a deal. But when it comes to like regional banks, like more banks, like big banks failing, like First Republic, I agree with Jerome Powell, where I think like, okay, those big three, Silvergate, SVB or First Republic Bank, those big three that failed, I think that those are like the big three that failed, and that's it, right? Like that's done. That's over. Credit Suisse didn't really fail. They just got acquired. They basically just sold their debt so that they didn't fail. But that's kind of like an international bank thing that doesn't really apply to us here in the US. But anyway, who acquired Credit Suisse? I think it was UBS. I think UBS acquired them. Yeah, I think it was UBS. But anyway, Credit Suisse failed. For me, that was kind of like the headliner of like, holy crap, Credit Suisse got acquired. Damn. Like, okay. But I think that's probably like one of, or the only big like international bank that like, okay, like, hey, we're not going to, the credit crunch is already too much for us. We know that we're going to be in the hole and we're going to fail if we don't let somebody acquire our debt now for like 80 or 70 cents on the dollar or whatever it was. So they sold out to UBS to basically bail themselves out from completely going under and having tons of international scrutiny. They got out ahead of time. First Republic Bank, they didn't. They decided to like hold on until the very end and like go down kicking and screaming. That's not normally how these bank failures go. We're not going to see another 2008. First Republic Bank held on as long as they could and went down kicking and screaming. But Silvergate, SVB, those were kind of special circumstances. Now that's where we get into Vice Chair Barr. Barr, elected by Congress. When he was put into place, our House was controlled by the Democrats. What do the Democrats not like, even though they always say to get elected that they're for it? Oh, we're for middle America. We want diversity and everybody to be able to have access to money and use money however they want. But then you get idiots like Karen, Elizabeth Warren, that's like, oh, crypto is a big problem. These banks failed because of crypto. Okay. The people in Congress that are Democrats that elected Barr are all anti-crypto. If you remember, just a month or two ago when Silvergate and all of that stuff was happening, what did Congress immediately do, including, Elizabeth Warren and a lot of the other people in Congress do? What did they do? They blamed crypto for it. Oh, it was because of crypto. Oh, it was because of crypto. Oh, crypto. Now all of a sudden, all this regulation around crypto. They elected Barr to put Barr into the Fed for oversight on purpose because he's anti-crypto. Like, that was a power play. That was their move. That was, the hand that they got dealt. They were like, okay, this guy's anti-crypto. Cool. Let's lobby for this guy to get him into the Fed. We need to cut this shit off because otherwise our bags aren't going to pump, right? Elizabeth Warren, her salary is supposedly like $167,000 a year, but yet she actually makes over like $2 million a year. I wonder how that's possible, right? You really think that kind of person is really rooting for, somebody like me or whatever that, makes like maybe 80 a year, 75 or whatever it is, a year? Like, no, no, my best interest is not their best interest. Like, it's not the same. We are not the same. I live out in middle America. There's tons of blue collar workers here. That's just not a thing. Like, they do not have your best interest in mind. They don't live in their own states that elected them. They all live in DC because that's where they are all the time. They don't have anyone's best interest in mind. They never have. They never will. Anybody that I think trusts politicians is an idiot. You don't trust your government. You don't trust your politicians. You elect them in good faith, but 99% of the time, they get to DC, they get corrupted, and that's just the way it goes. DC is a swamp, and that's kind of the way it goes. Now, that said, I think that the regulations for crypto are only going to get worse. I don't think it's going to get better. I think it's going to get worse. This starts getting into like Gary Gensler and everything at the Securities and Economics Commission because ding, 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 guess what? We have still no regulatory clarity on what defines a crypto as a security and what doesn't. There's just nothing. That's why Coinbase, I'm sure you guys saw Coinbase the other day. They had their attorney come on and be like, hey, guess what? You decide to give us a Wells notice? We're going to sue the living crap out of you. If you decide to go this route, it's going to be scorched earth. We are going to wreck you. That's the way that they decide to go. I think that that's 100% appropriate because all of these exchanges and companies and new businesses and startups that have been asking for years now, it's been like 2 years that they've been asking, we need clarity on this. We need clarity on this. We need regulations on this. Like, what defines the regulations? We need to know what's what. And just silence for like 2 years. And then all of a sudden, Gary Gensler just like comes out the closet with his stupid bald head, looking like what's his face from Barnes or whatever from The Simpsons, and just starts going, you get a Wells notice. You get a Wells notice. Everybody gets a Wells notice. And it's pretty ridiculous. Like, it doesn't make any sense. It's regulation by enforcement. That doesn't work. That stifles innovation. It stifles the American economy. And we're already seeing a lot of these businesses, they're moving out of the United States. They're going elsewhere. They're not staying here. They're going elsewhere that's crypto friendly. I mean, we're falling behind in that aspect. And it's in general, it's not a good thing for us to be falling behind that badly, and the US just like blatantly coming out and saying, yeah, you know what? I think the best way to go is to just ban it. What? Okay, so wait, you don't want free money. Like, okay, got it. Like, sure, that makes sense, right? Like, when does the government not want free money? So for them to do something like this pretty much tells me one thing. It's because they're trying to do a CBDC here in the United States. We already know that that's coming. It's already happened in a lot of other countries. It's not awesome. There's a lot of like TikToks and stuff that have gone viral in some of those countries that have been doing that. And in general, it's like not a good thing. If you want to have like zero control over your life and hand over all control to your government on where you can travel, what you can do, what you can buy, what you can eat, where you can go, what car you can buy, yeah, sure, like vote for a CBDC. If you want to have zero say in what you're allowed to spend money on and how you want to live your life, then sure, go for a CBDC. In my opinion, that's just for like liberal snowflakes that they already have zero control over their own lives. They just kind of wander through life. It doesn't make any sense to me. That's for the people that have no other way to make money than, being sex workers on OnlyFans and stuff like that. Those are the kind of people that would root for a CBDC. Oh, cool. I can get credits from the government if I eat health. Like, no, sorry, not for me. I don't want the government telling me that I have a limit on how much meat I can buy. I don't want the government telling me that, oh yeah, I really need this new car and it's cheap. Oh, sorry, it uses gas. You can't buy that. Like, no, I'm not for that. That's not my cup of tea. I'm sure for 90% of people, that's just not going to fly, because that is going to come to a vote. And I can promise you, all the conservatives that everybody loves to hate, they're going to shoot that shit down real quick. Plus primaries are coming up, and I can almost promise you we're going to flip the House. So the stuff like that is just not going to fly. The Democrats are getting desperate right now in terms of politics. They're just getting really, really desperate here. That's why they're making pushes to send as much money to Ukraine as possible here, because they know that if the House gets flipped, that's it. They lose all power. They don't have the House. They don't have the Senate. They don't have all they have is the White House, and Joe Biden is just in his own little fairy world. I don't know what his thought process is on stuff. He can't make it up the stairs in the morning. I heard from one of my friends that's retired Secret Service that was on detail in the White House that he actually left his actually, I don't even know if I should disclose this. YouTube might fucking ban me. So I'm not going to say what I know. If you guys want to know, you guys can DM me somewhere else or find me on Discord. But yeah, he left because it was a total shit show in the White House. Like he rejected the detail because he couldn't take it anymore. He said it was babysitting, like literal babysitting. That's all I can really go into on that. But anyway, that starts to get more into like the politics side of things. Obviously, the politics side of things does kind of play a large role, especially when it comes to our atmosphere, which is crypto. Gary Gensler, the oversight committees for all of that, and the people that he gives testimony to. Obviously, that has a very large role to play. But at the end of the day, it's not really, just kind of like Jerome Powell, right? Like, I don't want to, like, money doesn't give a shit about politics, right? Like Jerome Powell doesn't care about politics. Like his job isn't to sit here and take a political stance on something, because that's physically not his job. It's not really my job either, although I do recognize, and I think that all of us as traders and investors and being a part of this space need to recognize and acknowledge the fact that a lot of this is going to be politically biased, because politics, unfortunately, does play a role in finance, and especially in crypto now more than ever, because we have a big question mark over what kind of regulations we're actually going to be getting from this. I think that a lot of this is going to come in due time when it comes to basically SEC versus Coinbase. I think that that's going to shed a lot of light on what the landscape is going to be like. I have no idea if the Supreme Court is going to get involved in that or whatever. I personally hope that they do. I mean, it's not really the government's decision to control the money that people use. Like that's not really a thing. Like we use the US dollar, but there's no law against using something else as currency if people accept it. That's not a thing. So I personally hope that the Supreme Court gets involved in that. And I think that that's going to shed a lot of light for us in the future. So with that, I'm going to go ahead and check out. I know that this guy's been waiting for me to take a look at the ETH BTC chart. So we're going to do that real quick. Let me switch over to my chart here. I very, very rarely chart it against ETH, but sure. Wait, BTC ETH, right? Or ETH BTC. Got it. Oh my God, stop. And then after this, I have to go. I'm eating. I might as well just skip. I guess I'm skipping lunch today. I'm just going to call it an intermittent fast. I'm skipping lunch today because, yeah. Yeah, I mean, this ripped. I mean, it makes sense, right? Come and look at a daily here. I mean, yeah, it's mostly, you've got a giant range here with one throw over right in the center. Okay. You've got like this, right, as your support. And then you've got a big old, oops, you've got a big resistance up here. Okay. That looks like that. That's kind of your range. I mean, now granted, this is on a daily chart or whatever, but if you're bullish here, to be honest, this is looking very bullish. This would be my first target up here. I wouldn't target the highs. I never target the highs to, you know, like the all-time high or whatever for me to close out. This will rocket. I think it will, especially after such a long consolidation like this. I mean, like this price action has been largely flat in here compared to the rest of the chart for a very long time. Like, how long is this? 718 days. 2.5 years. It's done practically nothing. I don't know. I'm not really into charts like that. But I mean, definitely today in the last 4 hours, it's had a nice pop. But I mean, like, look at this retrace that it had here, right? You had this huge parabolic move up, and then it literally gave back. It hit the 764 right here, like perfectly on the nose. So I don't know. Like a lot of the moves have been like that. Like same thing with this. Like this went parabolic, and then it went like it gave back more than from where it started and swept the lows here, and at 127% retrace. So from that move. So I don't know, just really, really stagnant here in terms of the price action. If you're long on this, I mean, like shorter time frame, I'd be looking for this as the high. Actually, there's a little range here. This, like, that's your main resistance coming in to this high. If we're looking at like smaller time frames, make this just visible on the daily chart here. Take that off, and that's your swing low. So that's kind of like where you're looking. It looks like 0.06, yeah, 0.067. Yeah, I think this could move up higher. Let's look at the volume here. This is pretty consistent across the board. I like that this moved. Yeah, so this moved a lot higher. This is kind of bullish to me here. Let's look at yeah, momentum looks good. Momentum looks good here. We're averaging up, higher lows on the momentum. Volume per bar is also increasing overall. That's good. RSI looks strong. So I mean, in overall, my overall opinion is would be bullish on this, especially looking at OBV and breaking these comparative highs here from back here. Like that's really good. Like where it's breaking these highs on the OBV, which is really nice here. It's making a solid push up. So I would be looking for this to do something along these lines and be retesting these highs. That would be profit taking number one for me. You know, like obviously breaking above these levels here, you know, like that would be a good sign. This is another kind of one of those situations where you're just going to unfortunately have to take it level by level. So I'm actually going to leave all this stuff in my chart. I'll leave this here. This can just stick on the daily. This stuff can stay on the hours and minutes. There we go. Wait. I thought I said hours and minutes. What happened? Oh, it only had 4 hours selected. There we go. Yeah, I think that's pretty much. Eek, the collapse is coming. How so? Oh, you mean with what I said? I mean, I don't want to necessarily say that that would be like a full blown collapse, like in terms of like what I said with the banks and stuff like that. But to be honest with you, I mean, it's definitely possible. Here's what I think is going to happen. I don't think it's going to be an actual collapse per se, but what I do think is going to happen is we're definitely going to see like an economic slowdown. Like when he keeps saying, okay, we're going to have, I would like to see if we have a recession, I'd like it to be on the mild side. I think that that's what it's going to be. I think it's going to be a mild recession, like, stuff like that. Like, yeah, pretty much like tongue in cheek kind of thing. I think he's going to end up planning for some kind of mild recession. Recession, in my opinion, in any way, shape, or form, would almost be guaranteed, especially if they hike another 25 basis points. To be honest with you, I think they're going to look at the labor markets and they're going to look at the wage growth and the labor markets and the unemployment rate and stuff. And I think that they're probably going to make the decision that, yeah, they can handle it. Like, let's do another 25 basis points. It's going to be 2 or 3 months down the road until they make that decision. And they'll have a much better gauge on what happened at the 3 banks that did fail, if there is contagion that could spread because of those 3 bank failures. And was it the kind of same thing where like all 3 of those banks kind of had a similar problem? Or was it SVB and Silvergate that caused the contagion to First Republic? First Republic went down and it's kind of stopping there. I think that that's kind of, in terms of the big banks, I think that that's kind of the stance that he's taking on it as well, is that those 3 were like the really big ones to fall down. And if there's other ones, it's going to be like really small, like community, maybe 1 regional bank or 2 regional banks. And like the rest, if any other banks failed, it would be like community banks that were basically a part of, or, like sub banks of those regional ones, like really small community banks. So I don't think it's going to be really that big of a deal. In terms of wage growth slowing, the labor market cooling off, the housing market cooling off, like those are things that need to happen. Like those things slowing down doesn't necessarily mean that we're in a recession. But at the end of the day, like that's good. Like the housing market has been like literally on fire for like the past like probably 5 to 10 years, right? I mean, literally interest rates for houses have only gone down for like 5-10 years. I mean, it's ridiculous. Let me put it to you this way. When my parents bought the house that I grew up in, they bought it at a 12% interest rate in 1987. And that was a completely normal interest rate. Like it wasn't low and it wasn't high either. It was just kind of like the norm, like between 10 and 15% was like the norm for houses that you bought them at. But at the end of the day, you have to remember is that those prices for the houses were way less. Like my parents got that house for like under $200,000. They sold it for $750,000 when they retired. And that was 30 years, right? So in 30 years, they like literally 5x their investment. I mean, like that's insane, right? So, like, am I saying, oh man, we're going to see 10%, like rates or whatever on mortgages? No, of course not. I don't think that it gets to that point. But 0% rates, 2% rates, 3% rates, like that's not normal. Like everyone is complaining now that, oh my God, the rates are going up and they're over 5%, 6%. It's like, yeah, but like, dude, like where were you 5 years ago? Like that was normal. Like that's normal. We're just getting back into normal territory. So, I mean, recessions aren't short, they last a year, 2 years or whatever. And that just comes with markets returning to normal and supply and demand returning to normal. What we've had for the last 3 to 5 years is prices exponentially getting higher across the board because manufacturing costs have gone up and they pass the price on to the distributors. The distributors pass the price on to us, the consumer. And on top of that, especially like in tech and stuff like that, you've had these companies just bidding each other up, right? Bidding each other up, bidding each other up. And that's what ended up happening with the housing market as well, is that, people were just bidding each other up. I mean, people were just, no questions asked, buying houses in cash for like 20% over market value and just like eating up all the houses. Like that's not normal. Like that's the end of it. Like when you start seeing that kind of stuff happen, that means it's the end of a cycle. Like that stuff has already come to an end. Like the cycle is flipping over. Like the markets are going to start turning over. Housing sales are going to slow down. People that are able to afford houses are going to slow down. Why? Because there's going to be a credit crunch. Banks aren't going to be giving you a mortgage for a house unless you have absolutely zero debt to your name and you're a first-time home buyer. Anybody else that already has a house, or if you're trying to buy a house and get access to like the first-time home buyer, like the FHA stuff, and you have debt, they're not even going to give it to you. Not even as a first-time home buyer, they're not even going to give it to you. If you're in any debt now at all, this is why I've been paying off all of my debts for the last 2-3 years. If you're in any debt at all, you will not buy a house now. If you have any other outstanding mortgages, the banks are not going to give you a loan. They're not going to give you a fucking credit card. They're not going to give you nothing. And that's the way it's going to go. It's going to be impossible to get any credit because all of the banks are overextended and they don't want to fail. And they know that with wage growth slowing down and the labor market slowing down, that means less people have money to spend. And that means that those people that they already lent money to have less money to pay back their debts, i.e., ergo, they issue way less new credit to people, especially if they have outstanding debts on their credit reports. That's the way that it's going to go. That marks the beginning of a recession. And when that starts happening, I expect housing prices to start coming down. I expect the unemployment rates to start going up and the unemployment claims to start going up. And it is going to happen. Like, we're already through the height of the bubbles and the markets and the bull run. Like that's long since over in terms of like a broad economic view of what's going on. All of that stuff is over. It's already come to an end. Now we're turning the corner and we're going to start seeing the downside of printing $9 trillion out of thin air in 2 or 3 years. We saw the inflation. And now we're battling the inflation. We saw the housing market go crazy, and now it's slowing down. We saw wages and labor market just absolutely exploding, and credit lending like just out the ears just explode for the last 3, 4, 5 years. And now we're going to see that start slowing down, and it's going to turn the corner. Instead of everybody dishing out credit, the banks are going to start taking the credit back. They're going to start doing repossessions. People are going to start not being able to pay mortgages. People are going to start getting foreclosed on. All the people that were buying up crazy amounts of cars and stuff, like nobody was taught, nobody spoke a word about the commercial real estate thing. Commercial real estate is going to pop, and that's going to be really bad. Like, we're not going to see a housing market crisis. We're going to see a commercial real estate crisis, because for the most part, companies don't need buildings anymore. Like, all those buildings are pretty much sitting vacant, and now no one has the money to buy them. And if you were a big businessman, even if you had millions and millions of dollars to buy one of those, but you still needed some money from the bank, they're not going to give you the money to buy that building anymore. So, things like that are going to start happening. We're going to see a real big slowdown. I don't think it's going to be like a depression or anything like that, but we're definitely going to see an economic slowdown. It's already starting to happen. I mean, even normal, just average people like me, like, I'm already feeling this. Like, things are expensive. Like, wages aren't going up like they were 2 years ago. Like, I'm not making any more money than I used to 2 years ago. If anything, I'm making less, just because of the economy, and prices are either going up or staying very high. And it's been a slightly more difficult to make ends meet. I mean, now granted, my wife was just out of work for like a month. Okay. So I know I've felt it personally a lot harder than most people. But at the end of the day, like, yeah, like, luckily she was able to get another job before this starts happening and places aren't hiring anymore. Like that, whew, like, okay, she's good, right? Like, I was kind of sweating that for a minute because I was like, damn, like if this girl doesn't get a fucking job in like the next, if she doesn't get a job within 90 days, we're going to be in big trouble. Like, and I don't just mean financially. I mean, like, damn, like she won't be able to get a job because companies are sizing back and they're just not going to be hiring. So, that's kind of a big deal. I think we're in for more of that. I think this is only the beginning. I do think things are going to get worse. Like, oh yeah, look, they're going to pause the hike rates. Like, people in the markets that are investors and traders, they look at that as a bullish thing. I mean, technically it is a bullish thing, but when you start taking into account all of these other things that I just discussed, it's like not, we've gotten to the point where they're going to pause rates, but that just means that they're just going to stay here at 5%. And they're just going to leave all of that pressure onto the banks. So again, no more wage growth, no more labor market growth. Unemployment's going to go up. Credit lending is going to fucking, like, it might as well go to zero. Like, no one's going to be able to get any credit. Like, and that's just kind of the way that things are going to be going. When you go through QT cycles like this, I mean, maybe you're newer in the trading space, so you never really paid attention to this stuff before. But, like now you understand what it looks like when the economy starts slowing down. This right now is what it looks like. And obviously, since you guys are getting more experience now, you can look at all that stuff on charts. You can look at the wage growth. You understand what the numbers mean. Like, it's like, oh man, like, hey, what is the unemployment this month? Is it going up? Is it going down? Let's put that on a chart and put it on a weekly chart and see is the trend up? Is it down? Like those are good things. Like that helps you understand the financial environment that you and your family are living in. Like my wife, she always makes me laugh because she's like, oh, none of these decisions and none of these things relate to us. None of this affects us. It's like, oh, really? The price of that garbage Walmart beef going from $3 a pound to $9 a pound doesn't concern us. Like milk going from, $2.50 or $3 a gallon to like $5+ a gallon. That doesn't, you know what I mean? Like bacon going from $3 a pound to $12 a pound. That doesn't concern us. Of course it concerns us. She just likes to be ignorant with it because I'm the one that gives her money for the food. But at the end of the day, when you're in markets and you see these things happening and you understand how all of these things work and what's causing it to happen, when you understand that, did somebody say bacon? Bacon brigade? Did somebody say bacon? I love it. I think I'm going to go ahead and end the stream there, guys. I'm not going to eat lunch. It's like 3:00 here, my time. Markets, I think, are already going to be closing. I think they're closing here shortly if they're not already closed. They're closed like now. So it's going into aftermarket, or it's already aftermarket hours here. Market closes in 8 minutes. Yeah. So, I mean, it's kind of over. Big sell off into the end of the day here. This to me looks like it's just going to continue to the downside. I would be expecting a break of these lows, and then heading into some kind of like this level here. Okay. For consolidation. But we'll have to see. At the end of the day here, he has been, I didn't even show that on my screen. Whoopsies. S&P 500 right here. But anyway, yeah, that's kind of what I'm expecting to happen. Again, if you're new here, make sure you smash that like and subscribe button. That really helps me out. It literally forces the algo to put my live stream like up on YouTube so that there's more visibility to it. I want to grow the community. I appreciate every single one of you guys. Thanks for all of the follows, and make sure that you follow @VenomAlgo. All of that stuff is down in the description below. Make sure that you check out all those links, all the tools that you saw me using, like High Block Capital. All of that stuff is on there. It's not like a shill or whatever. I pay for this myself, and I use it literally every day. The heat maps and all the stuff that you guys see me do are down there. So make sure you check all that stuff out, especially if you want to diversify your portfolio and get into automated trading strategies and stuff. Check out cobra-trading.com. Link is obviously on the YouTube. And I think that's pretty much it for today, guys. I am doing another stream on Thursday, so just kind of more incentive to hit that notification bell. And I'm going to do my normal beers and Bitcoin stream just to kind of sum up the rest of the price action that we get over the next 2 days. On Friday evening, that's at 9 p.m. Eastern, 8 p.m. Central. I think something like that. I'll schedule it on my YouTube. You'll see it. But anyway, thanks for tuning in, guys. Thanks for coming and hanging out with me. Thanks for all the lovely comments and everything. Really appreciate all of your feedback. And until next time, happy trading.